The most valuable company on Earth makes the chips that power artificial intelligence. Trillions of dollars are being poured into data centers across every continent, and a growing chorus of central bankers, economists, and some of the most famous investors alive are all asking the same question. Are we living through the biggest technology boom in history, the biggest bubble in history, or somehow uncomfortably both at once? Let's look at the actual numbers fairly and let you decide. Start with the scale of the spending, because it is genuinely historic in a way that is hard to fully absorb. The four largest US cloud companies, Microsoft, Amazon, Google's parent Alphabet, and Meta, spent on the order of $400 billion on capital projects in 2025, and have signaled plans in the range of $600 to $700 billion for 2026, most of it going to AI data centers and chips. And one chip maker sits at the center of all of it. Nvidia became, in July 2025, the first company in history ever worth $4 trillion, and by late October it became the first to touch $5 trillion, a milestone reached just months after the previous one. On top of that, a single announced project called Stargate, a partnership of OpenAI, SoftBank, and Oracle, set a target of investing up to $500 billion in US AI infrastructure by 2029. To be precise, that figure is a plan, not money already spent, but it captures the mood. This is a build-out on the scale of national infrastructure. Before we judge today, we need a fair definition of a bubble. Economists describe it as an asset price that has risen well above the level justified by fundamentals, above what the future cash the asset can actually generate would warrant, driven instead by speculation and a self-reinforcing cycle of hype, where rising prices attract more buyers, which drives prices higher still until it stops. The classic modern example is the dot-com bubble. Internet stock prices soared through the late 1990s as investors priced in a future that was real, but decades away. The tech-heavy Nasdaq index peaked at 5,048 points on March 10, 2000. Then it collapsed. By October 2002, it had fallen roughly 78%, and an estimated $5 trillion in market value was wiped out in under 3 years. This is what a bubble looks like when you draw it. For 3 years, the Nasdaq more than tripled, from around 1,500 to over 5,000, as money poured into anything with .com in its name. Then in the space of about 30 months, it gave almost all of it back, bottoming near 1,300. Notice the shape, a near vertical climb, then a cliff. The technology underneath, the internet, turned out to be every bit as revolutionary as the believers claimed. And the crash still happened anyway. That is the paradox at the heart of this entire question, and it is the shape to keep in your mind as we look at today. The face of the mania was Pets.com, an online pet supply retailer with a sock puppet mascot. It went public in February 2000 and shut down and liquidated by November of the same year, less than 9 months from stock market debut to collapse. It burned out because it was spending $1.23 to ship every dollar of goods it sold, a model that required infinite outside capital to survive. But one company shows both sides of the story. Cisco Systems made the routers and switches that physically connected the internet, genuinely indispensable hardware, and briefly became the most valuable public company on Earth, worth more than $500 billion. Then it fell nearly 90%. Here's the striking part. Even though Cisco is a real, profitable, still dominant company today, its stock did not climb back above that 2000 high until December 2025, roughly a quarter of a century later. And yet the same era produced Amazon, which also lost more than 90% and then endured to become one of the largest companies in history. The lesson cuts both ways. Even when a technology is real, the price you pay still matters, and picking the survivors is far from obvious in the moment. Now the optimistic argument, and it deserves to be taken seriously because it is serious. The core rot of the dot-com bubble was companies with no earnings, often no revenue, sometimes no product. Today's AI leaders are structurally the opposite, among the most profitable enterprises in commercial history. In their 2025 results, Alphabet, Microsoft, Meta, Amazon, and Nvidia each posted tens of billions of dollars in annual profit. Nvidia's most recent quarter alone brought in about $57 billion in revenue, up more than 60% from a year earlier. Much of the build-out was funded not by borrowed money, but out of these companies' own operating cash flow. And there's real, fast-growing AI revenue underneath the hype. OpenAI's annualized revenue crossed $20 billion in early 2026, up from around $6 billion a year prior. Valuations. While high are nowhere near dot-com extremes at the peak, Cisco traded at well over 100 times its earnings, while Nvidia has recently traded closer to 30 to 45 times. Goldman Sachs, in a report literally titled "Why We Are Not in a Bubble Yet," argued the rally has so far been driven by fundamental earnings growth, not pure speculation, while carefully leaving the door open on that word "yet." And this is the bull case in a single line. For years, Nvidia's revenue sat quietly around $27 billion. Then in 2023, AI demand exploded to $61 billion, then $130 billion, then $216 billion in fiscal 2026. Nearly an eightfold increase in 3 years. Unlike the dot-com darlings, this is not a promise of future revenue. It is revenue already booked, already collected. That is the single strongest argument that this time really is different, that behind the mania sits a real, profitable, cash-generating engine that Pets.com never had. But the skeptics are not fringe voices, and their warnings come from institutions that do not typically shout about bubbles. In October 2025, the Bank of England's Financial Policy Committee warned that equity valuations appear stretched, particularly for AI-focused technology companies, and that the risk of a sharp market correction has increased, comparing conditions explicitly to the peak of the dot-com bubble. Days later, the International Monetary Fund echoed it, saying there are echoes of the late 1990s in the current tech investment surge. Deutsche Bank warned that for the boom to keep lifting the economy, investment would have to stay, in their word, parabolic, which they called highly unlikely. And the investor Michael Burry, made famous by The Big Short for predicting the 2008 housing collapse, disclosed bearish bets against Nvidia and Palantir, arguing AI firms understate how fast their chips wear out to flatter their profits. One honest caveat: headlines describe Burry's position as a $1.1 billion bet, but that was the notional value of the underlying shares. His actual money at risk, the option premium, was a small fraction of that, around $9 million on the Palantir leg by his own account. In a neutral story, that distinction matters. Two structural worries define the bear case. The first is what critics call circular financing. The same handful of companies increasingly fund each other in ways that can make demand look bigger than it is. Nvidia announced plans to invest up to $100 billion in OpenAI, which in turn commits OpenAI to buying Nvidia chips, while OpenAI also signed a roughly $300 billion cloud deal with Oracle and a chip and equity arrangement with AMD. Analysts at Bernstein, Mizuho, and Seaport call this circular, warning it can inflate apparent demand. Defenders call it ordinary vendor financing. What is important to say honestly is that there is no agreed figure for how much of this money is genuinely recycled versus genuinely new. The individual deals are real, but the aggregate circular framing is an interpretation, not a measured fact. The second worry is concentration. The so-called Magnificent Seven now represent roughly 34% of the entire S&P 500 by value, with Nvidia alone around 8%. The fate of the whole American stock market and the retirement savings of tens of millions of people is unusually tied to a few names making essentially the same bet. Here is the pattern history actually teaches. A technology can be genuinely world-changing and still trigger a bubble, with far too much money chasing it at far too high a price. In 1840s Britain, railway mania saw construction peak at nearly 8% of the entire national economy before the shares crashed by roughly 2/3. The investors lost. The railways stayed and became the backbone of Victorian Britain for a century. In the late 1990s, telecom companies poured over $500 billion into laying fiber-optic cable. Much of it sat unused as dark fiber. Giants like WorldCom went bankrupt in what was then the largest corporate collapse in American history. And yet that same fiber became the physical foundation of the streaming, cloud, and internet era we live in now. The economist Carlota Perez, who studied these cycles across 2 centuries, put it plainly, many of those companies never profited, but the frenzy left enough infrastructure in place for everyone to benefit. In 2026, the Bank for International Settlements grouped canals, railways, electrification, and the dot-com boom under one pattern, a genuine technological breakthrough that attracted capital in excess of what commercial returns could ultimately justify. Real breakthrough, real excess, both at once. There is one counterpoint for AI, though. Railway track lasted 150 years and fiber is still in the ground, but the chips inside AI data centers may be obsolete in as little as 3 years. Steel and glass age gracefully, silicon may not. So is this 1999 all over again? The most honest answer is that nobody knows, and anyone telling you with certainty in either direction is almost certainly selling something. What the evidence supports is this. Unlike 1999, the AI leaders make real, substantial, growing profits, and the boom is not primarily debt-financed. But like 1999, valuations are stretched, concentration is historic. And the gap between current AI revenue and the spending required to justify it is very wide. Sequoia estimated the industry may need $600 billion in annual revenue just to cover its infrastructure, and Bain put that figure as high as $2 trillion by 2030. A word of caution on one statistic you may have seen. A 2025 report from an MIT research group is often cited as proof that 95% of AI projects fail. That figure comes from a small, non-peer-reviewed working paper measuring whether custom enterprise tools reached production, not a verdict that AI has no value. Treat that number with the skepticism it deserves. So watch the things that actually matter. Watch whether AI revenue grows fast enough to justify the hundreds of billions being spent. Watch whether the build-out stays funded by cash or starts leaning on debt. And hold in mind the deepest lesson from railways and fiber. The technology can be completely real, the fortunes lost along the way can be completely real, and the infrastructure left behind can still change the world permanently, all three at once. The most interesting question here is not bubble or no bubble. It is how much gets overbuilt on the way to something that genuinely lasts. Thanks for watching. If this helped you think more clearly about the biggest question in markets today, subscribe, and I'll see you in the next one. This report was built from company filings and reporting by Nvidia, the Bank of England, the International Monetary Fund, the Bank for International Settlements, Goldman Sachs, and others, plus historical work on railway and telecom bubbles by Andrew Odlyzko and Carlota Perez. Chart figures come from company filings and Nasdaq historical data. Full sources are in the description so you can check every number yourself. Thanks again for watching.